All right, so we have finished the last full week before the election, and we talked about that last Friday, and we were looking for some weakness, and boy, howdy did we get some weakness this week. We also finished the month, and last September the 30th, I also did a market outlook video, and we talked about trading towards the lows of September, and now that we're at the end of October, we've done that too, and so this is kind of playing out as kind of expected here. The worst, the stocks that are suffering the worst are the ones that have the most to suffer, right? Because they've had the bigger winners and the bigger gains, and the poorer margin of safety. And so I'm going to show you that. I'm going to show you, okay, now that we have this week, are we going to get any more weeks like this? What will the continued weakness look like? And I'm going to use these different technicals to kind of give you an idea of what expectations are heading into the next couple of weeks and heading into October expiration, so 3 more weeks, November expiration, and then beyond that, as we get some finality to this election cycle with the Electoral College vote, and then potentially stimulus, potentially vaccine news, and we start heading into 2021 with a lot of tailwinds behind us. I'm going to break that down too. With our trade idea, taking advantage of the same thing we've been doing lately, trying to find stocks that don't have very good margin of safety and see how we can trade that. So let's go ahead and get started. Today is Friday, October the 30th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, in second consecutive day of dark pink shading and a red line. We did finish off the low, but even with that finish off the low, we're still pretty decently, so annoying. Still pretty decently here below the 30-day moving average. When you look at here, if I can get to it there we go. We are down about 3.5% below. We're not as low as we were on Wednesday because the moving average has dropped, and we just have barely closed just a smidgen lower than where we closed on Wednesday. Still flirting with that 23% retracement. We were down below it at the lowest of the day. The intermediate line obviously well below its market sentiment. Both are falling. The market sentiment's got a pretty decent chance of falling below 50. I wouldn't expect it to stay down below 50 for too long, as we'll talk about here in just a minute. But that's, we are obviously in a bearish pattern here, and that's the same for the Dow Jones Industrial Average bearishness. That's the same for the NASDAQ. You can see it's, for the first time, its intermediate line has fallen below the 50th percentile and got its dark pink shading. You notice it doesn't have a red line yet, so it's just barely starting. Then the Russell 2000 still doesn't have the intermediate line crossing below 50. It's barely crossed below its market sentiment, and it also does not have a red line. So, and it's sitting at that 78% retracement level of the decline that we had broken back up above here when we went bullish. So it's still kind of holding that support. Then you've got the 23% of the rally that's going to hold, and then the expectation is most likely fall down towards this 1425 area at that 62% retracement. By the time all is said and done, it's been holding up better because it's got a better margin of safety than the NASDAQ does. The NASDAQ has been actually been doing pretty well. It's really the S&P that's been kind of the worst performer, and the Dow, they've been the worst performers here as they are flirting with that 23% retracement level. More so than, say, even, well, the NASDAQ is too, but especially more than the Russell 2000. It's not even touching it yet. So it kind of gives you an idea of what's more bearish. And you also see, too, that we are barely below these September highs, whereas with the S&P 500, we're well below those September highs. We never did get above them like the Russell did. So Russell had some strength that the S&P didn't. That's why it got a cluster here. The Russell actually got a cluster right there. An overbought cluster. The S&P wasn't anywhere close to an overbought cluster. Let's take a look at the weekly chart because we're at the end of the week, and for that matter, we're also at the end of a month. We'll take a look at that chart too. Let's take a look at first the 5-year weekly chart. And you can see here that we got an oversold momentum line. It was a lot more oversold. It was actually flirting with the 5th percentile, and it finished up with that late rally. So it's a good good sign there that we didn't finish as low as we could have. The near-term line's dropping into the lower half of the chart, very similar to this week here where right in this area where the momentum line fell, but the near-term line hadn't yet. I think there's still another week or two. I don't think we'll get another week that looks like this with as significant of a drop as we've had, especially with us kind of really flirting with that moving average there. But I do think that we'll get potentially another week or two of weakness, again, coming down to the 78% retracement where we do flirt with that line. And, if we end up closing below it, so something like this is kind of what I expect that we'll see over the next couple of weeks. Heading into coming out of the election, we might get a pretty decent lower shadow, especially if we get a lot of weakness early next week, and then we ramp it back up and we close a week higher, but then we kind of trade within the range over the next few weeks as we get potential for courts getting involved with election results. And I think that's kind of our worst case scenario from a volatility standpoint. For the markets. But something like this here, you can see it got a relatively lower shadow there, and then we kind of traded within the range of that lower shadow for a couple weeks after that. That's kind of what I expect to see over the next few weeks heading into Thanksgiving and November expiration. If we end up with a pattern like this, with where we close below that moving average, we close near that 78%, maybe even just a smidge below it towards the 38%, and we get light pink shading, which we obviously would because we'd be below 80. It doesn't have to go very far below 80. You can see how bullish a pattern that was. It's a very bullish pattern. That was a very bullish pattern back then in August of 19, and it led to a really good rally. I expect very similar. I expect that by the end of the year, heading into next year, we'll be very bullish too. I don't know if we'll be that bullish, but we'll be pretty decently bullish too. And that might be what leads us. We might get that weakness into that pattern heading into, like I said, the next few weeks. Now let's take a look at the monthly chart. So I tweeted this out today. I mentioned to you last September the 30th, I mentioned that that we got a long lower shadow, and there's a very good chance that we can trade within that lower shadow. And we did. October, we did trade within that lower shadow, and we ended up getting a long upper shadow. That's about as long of an upper. This is a log scale chart. That's about as long of an upper shadow as we've gotten on the S&P. A little bit of a sideways pattern there, but you can see we typically don't get long upper shadows going over the last 10 years. You'd have to really go back some time to see, when we get long upper shadows. See, we typically either if we make a move higher, we close up there, but we don't typically finish the month down. We usually get long lower shadows, not necessarily long upper shadows. No, very, very, very few examples of the last 20 years, and really it's been over the last year that we've gotten the few that we've had. This one here in last February, or this February in pre-COVID. This one here in June, where we started the month off really high and then pulled back, and then now this month where we didn't quite achieve September's highs, but came that parabolic high, if you recall, and then pulled back by the end of the month. So from a monthly standpoint, again, you can expect to see that when we can still trade within, around that 78% Fibonacci retracement. We still have a very high, we're still very strongly above that 30-month moving average. So we're not looking to be too strongly bearish here. And that's actually a very bullish pattern, especially with market sentiment up there too, getting the near-term line below 50 and the momentum line down below here. I think we'll probably kind of peter around here for another month in November before December we can really get going, maybe with a lower shadow, but before we can really get going again and continue to ride this strong bullish trend that we've been on for a very, very long time, very mature bullish trend that we've been on since 2009, and really since 2010 when we crossed above 50. And then obviously in 2011 is when we finally got the green line and the green shading. So it's been a long, long period here. We'll just kind of keep our eyes peeled for any kind of breakdown like this one here that started that bear market in January of 2008. I don't expect that we'll get something like that, but you can see we had a few months of weakness heading into that, and we'll if we get something like that here, low probability, but if we get something like that in December, November or December, I expect November will be kind of more of a flat sideways market. Not relatively, right? Relatively to what we've seen here. I think we'll still kind of test the 78% level, but I don't think the high will get too high. So I think we'll stay in a relatively smaller range than what we saw with this 316 point range this time. Simply because I think the downside is limited to these support areas. I think the upside is very limited, because there's just not a lot of potential. Until we get through this volatility, there's not a potential upside yet until we get established in this bullish trend. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and you want us to do another video on Monday. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it with one click. You can do it right now even while you're watching. Also, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. It's my handle there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog post here on the video, check out some of these other things over here on the right, including our Market Outlook live video. I bring this up every time. I review all old Market Outlook trades. We continue to trade them until it's time to close them. And I talk about how and why in those videos. It's very popular. It's one of my most requested things. Every day I do the Market Outlook, I do a live video at 3:30 Eastern time. And this is what you click on. You can also just come up here to Market Outlook live trade review and find it there. If you come down here, in addition to our classes here, we also have some of our posts. Our monthly subscribers get access to all of our trading rooms, our premiums, and the Market Outlook live videos. Our premium subscribers get access to same things, plus our Q&A sessions, as well as some of our premium content. And one of the things that they get is this trade alerts. Every time we do a trade in our class, we send out those trades via Telegram, opening or closing. We send those out so you can stay tuned. I talk about our class portfolio that we trade in our classes. I just don't trade them in our classes. I also trade them in between the classes, and I let our premium subscribers know what we're doing in between with these alerts. So check that out there, and also come over here, hit this heart. It opens up a new window. Hit that like button right there. Come over here, hit this thumbs up icon. Also opens up a new tab. Come down here and hit that like button. Again, the more you do that, the more of our followers will see our content because it has likes and engagements and shares. As you can see, only 116 out of over probably about 1,500, I think, people that follow this page have seen this because again, that's how Facebook and Twitter work. It also benefits you when you click on these because they will promote content in your timelines from the accounts that you engage with the most. So the more you engage with us, the more you'll see our stuff. Again, we try to make it really easy for you. You can do it right now even while you're watching. All right, so here's another look at the weekly chart, and you can see the long lower shadow, the Hakinashi chart, but it's a long lower shadow, which means very good chance that we trade within the range, right? At the lower shadows, you notice these are the lows of the week. So, I expect that we'll trade within, we don't have to get to a lower low. We don't even have to touch this low this week. But I imagine we'll trade within that range next week, probably early next week, Monday and Tuesday, before we get some clarity, hopefully Tuesday night going into Wednesday, of what can happen. And even then, there could be a knee-jerk lower shadow immediately after that. So, but if you take a look at the PPO, it suggests that, yeah, we're definitely due for a few more weeks of bearishness, bearish Hakinashi candles. It doesn't mean we have to really tank, but it just means that we'll stay down in this direction as we flirt with that 40-day moving average and retest that, like, after a golden cross, which we haven't done. If we flirt with that and come down to that 78% Fibonacci retracement level, that's kind of my expectation over the next so many weeks. Enough to bring that PPO down towards, like 2.5, and then we can we're at a better level to start a new intermediate run. Very, very hard to start an intermediate run when you're already 5.5% gap between the 50 and 200-day moving averages. Let's take a look at the 3 green arrow chart. Obviously, we have 3 red arrows. The MACD is still moving to the downside. When you look at the 2 line versions, the MACD's moving average is now crossed below 0. The 8 and the 17-day moving averages are right there. And the stochastics moving average has crossed below 40. So these are pretty bearish signs that we are bearish. Now, again, when I say that, I know we live in this binary world where you either have to go up every single day or we tank. We're not going to tank, and most likely we're not going to tank. This has not been a tank, and market's been really worked up about this move. And as I mentioned to you on Monday and Wednesday, we don't get worked up about these moves. In fact, we were up a few $100 Wednesday. We were up a few $100 yesterday in our class portfolio. We were up about 1.5% today. So we manage our risk, we manage our positions in our active trading portfolio according to our posture. None of this has been surprising, so we don't get worked up about this, even if financial media kind of gets paid to get worked up about this kind of stuff. But it does mean that we can stay down here, right? We can stay in this area, and as I mentioned before, down into this 315 area is the most likely scenario where we'll kind of stall out on this weakness. Remember, the MACD can rise and we can still kind of grind our way to the downside, especially with the stochastics in the lower reversal zone, kind of showing that it's that the sellers are in control here. If you take a look at RSI and CCI, you see very similar patterns. We're dropping below 40 on the RSI. We already had dropped below negative 200. We're still below negative 100 on the CCI. Those are bearish patterns. If you look at the weekly chart, we were flirting with 50. We were below 50 and flirting with negative 100 at the lows of the week. So it kind of shows you how bearish we're getting on these oscillators. And if you look at the DMI, obviously still above 30 on the negative. We're still well below 20, so we're still in bearish. We have a bearish directional move going on according to that oscillator. And if you look at the trend strength, we are really close to getting a moderately strong bearish trend, kind of back to where we were over here. But this time we're below the cloud, and the price here is below and can stay below unless we really kind of take off, can stay below for a while. Probably will stay below until we cross into this area over here. So we can come up, but I think we'll still have a little bit of weakness first to keep that red line pretty easily below the price before it follows it back up and potentially crosses it in this area. That's where I would expect the red line, which is today's close plotted 26 days ago. I expect it will cross up, which means we'll be closing up 26 days from now up in this area once we cross, again, 26 days from now. So that's what these other oscillators are kind of showing, that we've got some bearishness right now going on, and the 3 red arrows also suggest that, and that's just not on the daily chart, but you notice we got renewed MACD histogram rolling over, some volume, and the stochastic rolling back down. So you got 2 red arrows looking for the third. I don't think that we'll finish this until we get that third. Then once we do get 3 red arrows, then we have a good chance at starting a new bullish run after that. Now let's take a look at the intraday chart, and you can see nice little close into the end, but again there's a reason why. It's because we are breaking down into very low levels of volume, and just as easy as it go down, it's very easy to come up. The question is whether or not we'll break up and really get going to the upside again, and you can see how unlikely that is. Even over here, there's some resistance now at 328, and of course you've got this volume node here. We're well below the value area. That's not going to change here for a while because it's going to take some time to get this volume cleared out. It's going to take more than a week. So again, another reason why you'd expect some weakness over the course of this next week. If you take a look at today's volume, it ramped up. We had pretty decent 120 million shares, above average on the ATR, not nearly as big of a deal. You can see this is about how big the days are going to be. We're not going to get huge downside moves, right? We're not moving into March where we get these big spikes. I mean, that was probably our biggest move to the downside we're going to get. Now, at most, will probably be 1-2% moves up and down as we stay right around this 2% level on the ATR. So again, it kind of suggests don't get too worked up about these things. Volume might pick up. I expect that the average volume will probably get back above this 100 million area, kind of where it got to 89 million there, and right now we're at 72. So expect some higher volume over this next week as well to pick that average up too. If you take a look at the volatility index, here's another reason why we don't get, like, I'm not expecting big time drops here, because the VIX is staying right around 105%. This is very typical of an intermediate pullback. I said before that I didn't believe that intermediate pullback in September was done. We had this kind of false breakout move that proved to be a false breakout, a fake out. And now we're still in the intermediate pullback, with the worst of it occurring now. As you can see, it didn't occur at the beginning, as is typical for most intermediate pullbacks. But as you can see, it looks to be occurring here at the end. There's the beginning, right? And so it looks like now we're coming to the end. And again, just at the 105% mark, we are not closing at the 115. We're not closing at the 125, where we gotta, where I would expect us to have a death cross on that 200-day moving average. So as long as we stay in this area, the more likely maybe the market sentiment dips below 50 a little bit, but not for very long, and we'll get this thing turned back around again. Is my expectation. That's what the options market is telling you. And I told you before, being above 40 is actually a very, very bullish sign in the long term. It's another one of those long-term tailwinds that I've mentioned that we have. Even if in the short term there still could be some more drawdown, and the VIX may come up a little bit into the low 40s. Got up to some highs over here. There might be a little bit more upside to the volatility, but I wouldn't expect a whole lot, and I wouldn't expect it to maybe between 105 and 115. Once we get above 115, now that's a market sentiment pullback, and that's where we will be a little bit bearish for a while. And I, not a death cross. That's 125, but long enough where the market sentiment might be below 50 for a while. Kind of again similar to other market sentiment pullbacks that we've had. If you look at here, let me zoom out to so you can see the orange line here. The orange line pulled that, so that was our death cross with the pre-COVID. That's where the VIX jumped up to 115. We didn't get a pullback there, but in early 2000 or late 2018 we did, and that was this not very much of a decline. We bounced right back up, and then in early 2018 too. That was a market sentiment decline. As you can see, we stayed down here for a while, but that that lasted a few months before we turned bullish. So I expect very, very similar type of action here. We are in this mode right now where we had come up and it looked like we were going to break out, but we didn't, and now we're kind of testing these lows, and that's the mode I expect us in. That's the mode we're in right now. And so there's going to be a little bit more downside potentially, and it's a little bit upside, and there's still going to be some up and down movement over the next few weeks until we finally settle into that bullish trend, and that volatility starts breaking itself down, and we can expect good long-term returns from here over the next year or even 18 months or 2 years. So just to summarize the technical outlook before we look at some other charts here, obviously we had a bearish week. Last Friday, we went into the weekend thinking we're probably going to get a bearish week this last full week of the election. We'll get some volatility this week, and we did, right? And so now I don't expect that we'll get the same amount of volatility. I don't think we'll have as big of a drop over the next few weeks, but I expect that we'll stay down here towards the lower end of this range as we have a little bit more volatility before things finally get settled down. So don't expect a big snapback pop next week, and of course anything can happen, and who knows, we might as well get one, right? But I don't expect that we will. I expect that we'll kind of stay down, just with less, I don't think we'll get a markets in turmoil segment on CNBC. I don't think we'll ever get that bad. It'll just kind of stay down. With some small ups and downs as we get some volatility. So there might be some days where we have up days, and that doesn't mean that we're back to being bullish markets again. It just means we have some up and down days, and I expect that to continue to be through the election, potentially into that November expiration, and then it depends upon, again, how long it takes to get an election result and how much the courts get involved in that, and that's going to be our black swan potential going into the electoral college date there in December. As to what could cause the worst volatility by the time all is said and done. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree. Comment as to why. What are you seeing that suggests why? What are you looking at? What charts or indicators are you doing? And share that with our community down below. All right, let's take a look at the asset classes and how they perform. Look at this 3-month chart again. You can see Q's still outpacing even with this pullback. And if I were to go to where this pullback, the current pullback started here, where we peaked on the 12th, we've been coming down ever since. If you take a look at what's been performing, what hasn't been, you can see, Qs are down, small cap stocks, all the way pretty much up until today. They were kind of down together going into yesterday's little rally. But then there was a big, this is probably the biggest gap that we've seen during the whole decline. Here, maybe a little bit up into this area where small cap stocks are actually pretty close to break even and the Qs were down 3%. But now we have a pretty decent gap again, but regardless, IWM is still bearish, so it's not like it's really outperforming significantly. What is outperforming significantly is emerging markets, and that continues to be the case even with strength in the dollar. Now, recent strength in the dollar has put some pressure because at one point in time during this weakness, emerging markets were actually positive. But once the dollar started to take off, then emerging markets started to underperform too. But they're holding up well. Gold's down. This is an interesting development. Again, as weak as we are, and especially over the last couple of days, this weakness that we've had pretty much since Tuesday's close, with stocks are down from Tuesday's close. In fact, that would be Wednesday, Thursday, Friday. Let me just show you this here. So we go from the 28th over. And let's look at a 15-minute chart. So we get some price points. So stocks are down. Stocks gapped down on Wednesday, stayed down, rallied up Thursday, came back down. Bonds started the day on that gap higher, and the dollar continued to move. But look at bonds. So stocks are down still 3.5% in the last 3 days, and bonds are down almost 2%. So that kind of is pretty significant in terms of we're not falling off a cliff here. Commodities are bearish, and they kind of led a lot of this weakness. But, we're not, if we were falling off a cliff, you would see gold and the dollar up. You would see bonds up too. And that's not necessarily the case. I mean, if you look at bond yields, if I take a look at bond yields here, and we'll look at the weekly chart for the 10-year yield in particular, and it's having a pretty decent week, and it finished strong today. It's up to 86 basis points. The 200-day moving average is at 90 basis points. This thing is headed for a golden cross point, which would mean that we'd have to get up to about 100 basis points for that to happen. And that's not signaling a bear market. And you can see the yield curve here continues to steepen as we get higher. You can see it's a monthly chart here, and this isn't here. This needs to be updated still for let's try this again. This needs to be updated for today, because we're still only at 79 basis points. But you can see the 2-year is staying flat. It's not really rising very much, and the 10-year is. So that yield curve steepening again is not very typical of bearish markets, right? So again, it's a reflection of the Fed keeping rates low, and all these times where the rates rise, the markets are pretty darn bullish, and that would be the expectation here, even from 03 to 04, where rates stayed low and the 10-year note was rising. Those are pretty bullish times for stocks. So again, don't get wrapped up in the volatility. Don't think long term. Don't get the short-term volatility confused with the long-term tailwinds that are really pushing stocks forward here and eventually getting us through. So they're also suggesting that don't get too wrapped up in the weakness, even in commodities or gold. Commodities trying to get that golden cross and unable to, and getting some weakness. A lot of times that happens. You get that failure to cross when you're first ramping up to it. So we'll come down to this 38% retracement level. We'll stay in this area where some support is, and then we'll have a better shot with a new bullish trend to get through that. But expect a bearish trend to come out of this bearish candle that we're getting. Let's take a look at the major markets again, the major ones especially, the biggest ones. And we're still continuing to see some very good strength, relative strength, in China, India, and South Korea. I mean, they're showing light pink shading and red lines, but everywhere else, especially in Europe, is just getting hammered. So these are not even in the U.S., these are not the places to be. The places to be are where, for that matter, COVID has been handled better. Now, of course, it's different populations and different demographics. So you can't expect one country to exactly control a virus the same way when it impacts people with different health issues differently. So, but the fact is, they are outperforming. And so we can take note of that and take advantage of that. We have been in our portfolio management class, while also noting where the weakness is in these really hard hit European areas. And the U.S. is kind of following that mode right now from a health standpoint than it is following what we're seeing in Korea or elsewhere, and even not so much India, but Korea and elsewhere in Southeast Asia. All right, from a sector standpoint, if we do the same kind of comparison, you can see our technology and communication services and discretionary doing so well, pulling back, industrials as well. Again, going to that same 2000 or from the peak here on October the 13th, excuse me. Take a look at what's really been dragging things down, and technology, communication services was actually holding up pretty well until today. And you can see utilities are holding up, and that's not surprising. Materials is up, it's got a little bit of a link to gold. Everything else this is a pretty broad selling, but especially the weakness in technology is really getting hurt. And if you look at the last couple of days here, again, this Wednesday, Thursday, and Friday of this week, that's where the weakness has been. Healthcare too, but technology, discretionary, and communication services. Let's go all the way to the beginning of the week, because we had that down day on Monday as well. And you can see utilities and real estate really holding up. Staples up there too. Communication services holding up because they had really rallied on Thursday and kind of left the market behind. It was kind of matching the market. But technology, on the other hand, was outperforming and then ended up being down today with some weakness. So not surprising, right? Industrials are down there too. So we're not getting a great rotation. Once this is all done, we would expect technology, communication services, these stocks that we're taking advantage of that are showing weakness, more weakness than others, they'll eventually turn around and show more strength than others. They have been showing more strength. We expect that they will continue to show more strength as we head into a long-term bullish period for equities. Again, I'm not talking about like long-term as in 5, 6, 10 years. I'm actually pretty bearish on stocks in the long term. I don't expect big returns. But in the next year or two, I do expect that we'll get some pretty decent returns, led by what's been leading us so far. Until commodities grab the reins, which, these inflation, when inflation kicks up and the Fed has to start raising rates and commodities really start to take off, then that will be kind of the sign. That will be the rotation that we'll see. But that won't happen. That typically happens usually after the market peaks even and rolls over. So it's going to be a while before we'll get the great rotation trade here. All right, so that takes us into our trade idea of the day. And I wanted to take a look at another one of those QQQ type names that has a very poor margin of safety, and that's Tesla. Tesla's been rolling over. It's down 5%, 5.5% today. It's breaking below Fibonacci support. It's breaking into a big volume gap. There's this very, very little volume support in this area. So it doesn't mean it has to go down. It just means it's really easy for it to go down. Now remember, once, if we fall down quickly and we hit support down in this area, then we can jump, depending upon how much we fill in, we can jump back up just as quickly because it would still be there. It just depends on how fast and how much volume we fill in. So keep that in mind. Like as bearish as we are and as much as you can drop, it can also bounce. So but very, very poor margin of safety. You can see the market forecast is turning bearish for the stock. It's really, really close to dark pink shading. We'll have it on Monday below a falling moving average or market sentiment. The moving average is rolling over and headed lower. You take a look at the two-line versions of the 3 green arrow charts, and you can see MACD moving average rolling over. The stochastics moving average is down at the lowest levels it's been. The 8 and 17-day moving averages are down below its 30, and we're really breaking down there. You take a look at, we already looked at the Bollinger Bands, the RSI and the CCI. A little bit of a move up off of the lows of the day, but we were a lot closer to negative 200. We're still close at 172, lower than what we saw there. The RSI is closing below 40 for the first time. That's a bearish pattern. The DMI, when I take a look at the DMI here, this is the highest negative value that we've seen since back here when we had that pullback, obviously above 30. The first time the positive has dropped below 20 this entire time since the same pullback. So even with this little weakness we had there, we're weaker. We're getting more of a directional move now, the potential of one, with rising ADX, rising bandwidth, than what we did there. That was just too fast, right? We went down and up just like that. If you take a look at the trend strength indicators here, you can see they're also setting up for the beginnings of a moderately strong bearish trend, almost below -2, already above 65, and flirting with breaking below the cloud, the Ichimoku cloud there. So obviously an opportunity for a bearish setup here on Tesla. So what we're going to do here is we're going to sell the 315 and buy the 320 put and sell the 315 put, which is further out of the money, to help finance that. So it keeps my risk really, really low. As you can see here, I've got about a $500 risk, half a normal position for what we normally manage. But you can see it's a really aggressive trade because there's so little margin of safety. And if this does work out, we get a 7-to-1 reward to risk ratio, and that's if we lose 480 bucks. If we lose a couple hundred, if we just bounce right up here and we lose a couple $100, then we're looking at 10 plus 14-to-1 reward to risk ratio. So it's a really aggressive trade. It's a really high reward risk ratio, which means it's very low probability too. But considering all the bearish signals and the bearish pattern showing up here, and that really poor margin of safety, there's an opportunity for us to be aggressive on a stock like this, and that kind of reward can give us a little bit of a hedge, because remember, our long-term portfolios are pretty darn bullish. That can give us a little bit of a hedge over the next few weeks. Remember, that's a November expiration, so this would be over a few weeks. Right now, 319 is where one standard deviation is, so 315 would be just a little bit below that. As that kind of changed a little bit here at the end of the day. But we'll, again, with very low support, I wouldn't be surprised if we got bigger, and especially considering it's Tesla, don't be surprised if we get bigger than a 1 standard deviation move in any kind of period of volatility. The stock is up 500% over a year. It's up 363% year to date. It's up 150% in the last 6 to 9 months. So there's some volatility to the upside and the downside, and we're banking on this idea that if there's some broader weakness in the macro level, that it can show up here, and we've got a little bit of a hedge now to be able to take advantage of it. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, get access to that. Open up any new threads there with any questions or comments you have. Reply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching our video today. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on Twitter and Facebook too, as well as YouTube. And then comment on the video. Have a great weekend, everybody. Great rest of your Friday night. A great Halloween weekend. And we'll see everybody on Monday.